Yes, welcome to question 2. Question 2 of our paper, Financial Accounting. The paper was done by the KASNEB CPA December 2024. Now, question 2 reads, it's giving a case study. Anne, Ben, and Chad have been operating a partnership business under the name ABC Traders. Anne, Ben, and Chad have been operating a business under partnership under the name ABC Traders. Their partnership agreement provides for a profit or ratio sharing of 5:3 to 2 or 5:3 to 2 respectively, which means that Anne gets 5 of 10, 5 out of the 10, Ben gets 3 out of 10, and then Chad gets 2 out of 10. On that 1st December 2023, Anne retired from the partnership and left Ben and Chad to continue with the partnership, sharing profit and loss equally. On that 1st December 2023, Anne retired from the partnership and left Ben and Chad to continue with the partnership, sharing profit or loss equally. The following balances were extracted from their books for the year ended 30th June 2024 before adjusting for Annie's retirement. The following balances were extracted from their books for the year ended 30th June 2024 before adjusting for Annie's retirement. In terms of land at cost, this is in terms of thousands. So we have 2,400, which is now in terms of thousands. Now that makes it 2,400 million, but we'll use in terms of thousands. Land at cost was 2,400. Building at cost was 6,400. Equipment at cost was 960,000. When you talk about at cost, remember on the first question we spoke about that concept whereby we say that assets are recorded at their price, at their cost that they were purchased at. Then we have accumulated depreciation on 1st July 2023. We have accumulated depreciation on building that was 480 and equipment at 220. Trade receivables were 1,368. Trade payables were 1,624. Allowance for doubtful debts on 1st July 2023 were 42. Cash at bank was 84. Capital account as at 1st July 2023, Anne had 3,600. Ben, which was credited, Ben had 3,400. Chad had 3,200. The current account at 1st July 2023 purchases Anne at 60, Ben at 40, and Chad at 40. Let me check if that question is okay. So purchases were 5,820. The sales were 9,880. Staff salaries and wages were 1,172. Rent and rates was 500. General administrative expenses were 284, and the bad debts written off were 18. Additional information. Inventory was valued at 1,620,000 and 1,800,000 as at 1st July 2023 and 30th June 2024 respectively. Second additional information, as at 30th June 2024, rent and rates paid in advance amounted to 100,000 shillings. Number 3, as at 30th June 2024, general administrative expenses accruing amounted to 88,000. The partners made the following drawings during the year ended 30th June 2024. And as at 31st December 2023, she withdrew 420,000. Ben, as at 30th June 2024, he had withdrawn 740,000. And Chad, as at 30th June 2024, he had withdrawn 720,000. Additional information number 5. Depreciation is to be provided on a straight line basis as follows: asset building at 2% rate per annum, equipment at 15% rate per annum. Number 6, allowance for doubtful debt to be increased to 48,000. Number 7, balance due to earn was to remain in partnership carrying no interest until 1st July 2024. Then number 8, the value of partnership goodwill as at 31st December 2023 was agreed by the 3 partners at 4 million and was not to remain in the books for the partnership. Then number 9, on that 1st December 2023, the partners agreed to revalue the land upwards to 3,200,000. Then lastly, number 10, assume profits accrued evenly throughout the year. Required. Number 1, prepare a statement of profit or loss and appropriate account for the year ended 30th June 2024. And then secondly, prepare a statement of financial position at the year ended 30th June 2024. Both questions have got 10 marks each. So we start by preparing the statement of profit and loss account and then appropriate account. I did say that when you prepare this statement, you would start by preparing the normal profit and loss statement. So I can start by indicating. We have been told for the year ended 30th June 2024. It's good to start by drawing this format. All right. So in our statement of profit and finance, we start with the sales. From the information we have been given, the sales were 9,880, So this is in terms of thousands. Let's put it that way. So we have our sales to be 9,880. Then now we less the cost of sales. In the cost of sales, we start with the opening stock. In terms of opening stock, we have been told from additional information number 1, we have been told inventory was valued at 1620, 1,620,000 as at 1st July 2023, and 1,800,000 as at June 2024. So 1,620,000 is the opening stock, and 1,800,000 is the closing stock. So we take 1620 to be our opening stock. So we put 1620 here. Then of course we add purchases. We have been given purchases to be 5820. So we add purchases. Just let me show the balancing. The purchases is 5820. Then we less in fact, when you add this, if you add this opening stock plus purchases, you are likely to get, that is 04, that is 14, car 1, 6, 7. In fact, here you are going to get cost of goods. So you less closing stock. Earlier there we were told the closing stock is 1,800. So we are going to get there. We are going to get what we call the cost of goods sold. That is 7,440 minus 1,800. You will get 5640. You will get 5640. So we have 5640 here. So let's less the 5640 from our sales. So our sales is 9,880 minus 5640. We are going to get 4240 as our gross profit. So this is gross profit. That is that means that we have got our sales, we have less the cost of sales from so we have our sales at 9,880 in terms of thousands. Then we less the cost of sales. We started by getting the cost of goods, so we added the opening stock plus the purchases that were done within that period. We get our cost of goods, then we less the closing stock for us to find the cost of goods. So if we minus the cost of goods minus sales, we'll be able to get the gross profit, which we have done. So from the gross profit, we less expenses. And in our expenses, we'll start with depreciation of assets. So if you look at from additional information, we are saying that we are being told that depreciation is to be provided on a straight line basis as follows: building 2% and equipment at 15%. So we are going to look at the depreciation for building and equipment. So we'll have building here, and then depreciation for equipment. So building, we have been told, is 2% off, and then I think equipment we were told 15% off. Yeah, 15%. So we go to the cost, building at cost and equipment at cost. So building at cost is 6,400 and equipment is 960. So 2% of 6,400 and 960. So if you take 2%, that is 0.2. So 2 divided by 100 times 6,400, you will get the depreciation being 128. Then you take 15%, so 15%, that is 0.15 times 960, you will get the depreciation for equipment being 144. So that is it. Then the next expense, that is the first expense from depreciation. The next expense, we have increase in allowance. Remember, we have been told from our information, number 6, allowance for doubtful debt to be increased to 48,000. So if you look at allowance for doubtful debts in 1st July 2023 was 42, and they have been increased to 48,000. So it means that we want to get at what margin did the increase. So because it's in terms of thousands, we will have to have 48 minus 42, because the increase from 42 to 48. So we are going to get the increase is in 6,000. I mean, because it's in terms of thousands, we'll put that as 6,000. Now the next expense, if we look here, we have staff salaries and wages, we have rent and rates, we have general administrative expenses, and we have bad debts written off. So we will include first, we will talk about staff salaries and wages. Then we'll talk about rent and we said rent and rates. Now staff salaries, let's put the figure there first. Staff salaries, we have been told to be 1172. There's no additional information that is affecting staff salaries, so we have 1172. Rent and rates, we have our rent and rates from the information above. Rent, our rates are 500, but there's information affecting that. Additional information number 2 states that as at that 1st June 2024, rent and rate paid in advance amounted to 100,000. So this is paid in advance. So we need to less for us to find out what is the expense, because now the payment in advance is not an expense. So what we'll do, as part of the expense, we are going to minus 500 minus 100, which was paid in advance, for us to get rent and rates at 400. Then we come to the next expense, will be general administrative expense. So we indicate general administrative expense. Now, in terms of general administrative, from our information here, general and administrative expense is 284,000, that is, but there is an information affecting that from the additional information. If you look at the additional information number 3, states that as at that 1st June, general and administrative expenses accruing amounted to 88,000. So they are accruing. So means that we need to add these accruals in terms of general expenses to the general administrative expenses. So we'll take 284 plus 88. So if you do that, 284 plus 88, you will get 372, I think, yeah. You will get 372 as the expense. And then we move on. The next expense is bad debts written off. Bad debt written off. There's no information affecting that. So bad debt written off. We were told the bad debt written off were 18. So 18,000. So we'll have 18 there. So those are our expenses, or total expenses. Let's get the total. If we calculate that, that is 128 plus 144 plus 6 plus 1172 plus 400 plus 372 plus 18. You will get 2,000, the total expenses being 2,240. So we less that from gross profit, that is 4240 minus 2,240. You will get the net income being 2,000. So here we have our net profit. So that is the first stage. We have made the profit and loss account. We have got our net profit at 2,000. Now let's add the appropriate account. So what we are going to do, we are going to less share on profit, because we go with the question in terms of depending on the information that we have been given. We were not told if there was any interest, the amount of interest that was earned, if there were any salaries paid to any partner and stuff like that. That's no information. The only information we have is now on the share on profits. And when it comes to share on profit, we are being told that from the above information that on that 1st December 2023, Anne retired from the partnership and left Ben and Chad to continue. And then at this point, the sharing ratio was 5:3 to 2. 5 for Anne, 3 to Ben, and then 2 to Chad. Then on the other side, the information we are supposed to prepare is from 1st July 2023 and then all the way to 30th June 2024. So which means that Anne left in the middle of the financial year. So that tells you that from 1st July 2023 to 31st December 2024, the profit was shared equally. So half of it, because now this is we are talking about sharing of the profit 2,000. for the 1 year. So a half of it was shared in as a first ratio of both three, then a half of it from 1st January now to July that first, June that first, 30th. The other half was shared among the two equally. So the sharing of the profit, we are going to start from we said that 1st July 2023 to that is it 30th when Anne retired, that first, sorry, so to that first December 2024. So the profits were being shared according to Anne, then Ben, and Chad. So I like, just allow me to okay. So this is Chad. So we were being told the ratio, I think they have arranged them well. We were Anne, Ben, and Chad. The ratio was 5:3 to 2. So the ratio is Anne is 5/10, Ben is 3/10, and then Chad is 2/10. So times. So we have, because this is from that 1st July 2023 to that 1st December 2024. Sorry, this is 2023, not 2024. Corrections on that. (2024). This line is supposed to be. No. Now, because I'm saying that the first sharing of profit happened for the half year, and the net profit for the whole year was 2,000. So which means that a half of the profit was what was shared among the three. So if it was a half, that means it's 1,000, 1,000, and 1,000. So that makes it that is 0.2. I can have a calculator on that. So if you can have, it means that a half of 1,000, that was 500 shared for Ben, then 300 is what was shared by 500 shared by Anne, 300 shared by Ben, and 200 shared by Chad, which makes a total of 1,000 shillings. Then now we have the profits that are being shared from 1st January 2024 to 30th June 2024. The profits are being shared between now Ben and Chad, because Anne had retired, and we were told that now the profits were shared equally in the ratio of 1 to 2. So that is 1 to 2 times the remaining 1000 and 1 over 2 times the remaining 1000, which gives that Ben got 500, then also Chad got 500. So if you do that, then now the next thing is for us to get the total profit shared. Let's get the total profit shared. So we have the total profit shared by Anne, by Ben, and by Chad. So if we look at the total profit shared by Anne got 500 and it was only once. So Anne got 500. Okay, let's put this here. Anne got 500. Ben, in the first half, Ben got 300 plus the second 500. So in total, Ben got 800. And then Chad initially got 200 plus now the next 500. It means that Chad got 700. So if you had the total, that is 13, it comes to 2000. That those are the profit that were gotten. So if okay, allow me to put these figures on the other side so that I can just allow me to do some literal correction. So Anne got 500, Ben 300 got 800, and Chad got 700. So if you add 500 plus 800 plus the 700 that got, they all got there's no need for this line, they all got 2000. So if we less the profit that was shared from the profit, the net profit, the retained earnings will get them as 0. So this is what we call retained earnings. So it was 0 after them sharing the profits according to the percentage that we were given above. So definitely this is how you prepare your profit and loss account. I think I had prepared it earlier, but I wanted us to move step by step. So if you look at our preparation, I have prepared the statement of profit account, statement of profit and loss appropriate for the year ended 30th June 2024. We have our sales. Here we have indicated. We less the cost of goods sold. We add opening stock plus the purchases that we are given. Then we less the closing stock. We are able to get the cost of goods sold. So we less it from the sales for us to get the gross profit. Then we, after getting the gross profit, we less the expenses. So our first expense will be depreciation, and we were told depreciation that were happened on a straight line were for the building and equipment. So we check on the building, which is which we were told depreciated by 2%. So 2% of the cost of the building was 6,400, and the equipment was depreciated by 15%, and its cost was 960. So we get 128, 144. Then we have the increase in allowance. We were told the allowance increased from 42 to 48. So the increase is by 6. So staff salaries and wages were that there was no any information that was affecting them. Then rent and rates was 500 minus the pre. Is it postpaid? I'm missing the word. Just sorry. We were told from the additional information, we were being told that at that 1st June, rent and rate paid in advance. So advance payment or the rent that was paid in advance, it's not an expense. So we have we less the rent and rates minus the one paid in advance for us to get the total expense at 400. Then general administrative expenses were 284, but also we were told that there were accrued expenses at the end of that year, so we add it for us to get the total general administrative expenses at 372, and the bad debts written off were 18. So if we add all the expenses, our total expenses comes to 2,240. So if we less it from the gross profit, we get our net profit at 2,000. So let's less from the net profit the share on profit. The share on profit happened twice because at the half financial year, one partner left. So equally, there was the ratio that they were sharing the profit. So we calculate that for the first half of the year. That was between Anne, Ben, and Chad. They were to get 5/10, 3/10, because the ratio was 5 to 3 to 2. And so which means it was a half of the year. So we use a half of the net profit for us to get the profit that was shared by each member. Then there was the profit shared for the remaining half from 1st January 2024 to 30th June, the other 6 months. So we have, it was shared equally between Ben and Chad, that they got 500, 500, so 1,000. So if you had the total profits, for Anne it was only 500. For Ben, as we have said, it was 300 plus the 500, 800, and then for Chad is 200 plus 500, we get 700. So the total profit that was shared was 2,000, which means that if we less it from the net profit, the retained earnings was 0. So that is our profit and loss and appropriate account. The second question, we were being asked to prepare we were being told we are required to prepare the statement of financial position. Now, when you talk about the preparation of statement of financial position, I will want us to start by preparing the adjustments first before we start. Now, I have the adjustments that are prepared. Now, we will start with our partners. We'll start with the partners' current accounts. Okay, let me take it right. Let's start preparing one by one so that it becomes easier for us to do that. Then later we will come to understand how that information was prepared. So we start by preparing the partners current account. So in terms of a partners current account, we had we have Anne, we have Ben, and then we have Chad. So from the partners parent accounts, we are going to credit we have been told, let me go to the question. We have been told from the current account 1st July 2023 The purchases should be not, this word should not be here. So from the current account, 1st July 2023, we have been told that Anne was 60, which was credit, and Ben was 40, which was debited, and then Chad was 40, which was credited. So if we do that, we debit the 40,000 for Ben, then we credit the balance brought forward. This is balance brought forward to 1st July 2023 for so we debit for Ben, and then we credit for Anne and Chad. So Anne and Chad is 60 and 40. So we check on our partner's current account. So we say balance brought forward. For Anne, we credit 60. For Ben, we will debit, and for Chad, we credit 40. So for Ben, balance brought forward, we debit for Ben. Then now we will check on the drawings that were done. We debit the drawings from the information is very clear. From the information that we were given, we were told the partner made the following drawings during the year ended at 1st June. Anne withdrew 420. I need, let me write that somewhere. So Anne withdrew 420, Ben 740, and then Chad 720. So we are saying that in our partner's current account, we will debit the drawings. So Anne withdrew 420, Ben withdrew 740, and then Chad withdrew 720. And for the partner's current account, we credit the share on profits. Share of profits. So in our earlier calculations, we have gotten how the profits were shared. Anne got 500, Ben 800, Chad 700. So Anne, in that share, Anne got 500, Ben 800, and Chad 700. I think that is right. In the share of the profit, right. That is what exactly is there. So we get the balancing figure. So the balancing figure is now the balance carried forward. I think it will be on this side because this will be the total 740, 800, 560. So that will be 740, 800, 560. So the balancing figure 740 minus 720, you get 20. 740 plus 40, you get 80. So 800 minus 780, you get 20. 560 minus 420, you will get 140. So that is the balance carried forward. All these are in terms of thousands. That is what we have been using. So all these are in terms of thousands. Let's remember that. Now the next, we can prepare the goodwill account. We can prepare the goodwill account. So we can prepare through the T account. So we have our partners, Anne, Ben, and Chad. So we have Anne, Ben, and Chad. Also, this is in terms of thousands. Remember. Now, in the goodwill account, what we are going to do, we are going to credit. Okay, sorry. Allow me to do some corrections. Kindly. Because we are doing it in ratio, I will prefer we put our partners like this, Chad, rather than putting them where's this rubber? I hope you are following keenly. So we have Anne, we have Chad, we have we have Ben, then Chad. So we will credit the goodwill account. We will credit the initial amount that the shares that they were to share initially. That was 5 to 3 to 2. We were told that our from additional information number 8, the value of partnership goodwill as at 31st December 2023 was agreed by the partners at 4 million, which and was not to remain in the books for the partners for the partnership. So we want to write it off by preparing that T account. So in terms of the first books, in terms of the first ratios that they was sharing, they were doing 5 to 3 to 2. So times 4 million times 4 million. And then we will be able to share the credit using the we debit the sharing of the profit using the agreed new ratio after Anne had retired, that was equally to times 4,000 times, okay, let me put times 4,000 because I will want us to use the thousands all the way, so that we are not going to so that we cannot be lost somewhere. Consistency is very important when you are doing these calculations. Now, definitely this is 2,000. This is going to be 2,000. That is you cancel one there. That is going to be 1,200. Cancel there. That is going to be 80. 0, 0. That will be 80. So that will be cancelled. That will be 2,000, right? If you cancel that, that will be 1,200. Sorry, this is supposed to be 5,000. That is why I was getting confused. Why is it not making sense? Thanks. Now we have the correction. So the goodwill account will balance at 4,000. It will balance at 4,000. So because the goodwill was not maintained in the books, so we write it off. So then our next account that we are going to prepare is the capital account. So we will still prepare the T account. So we'll have our partners, Ben and Chad, and Ben and Chad. So in our capital account, we are going to credit the balance, because I think it's also well explained there. In our capital account, from the question, we are told that the capital account as 1st July 2023, we will debit the balance carried forward. Sorry, we will credit the balance carried forward. Let me write this somewhere. For Anne, the balance carried forward was 3,600. For Ben was 3,400. For Chad was 3,200. So we will be able to credit those amounts. So in our capital account, so balance brought forward for Anne was 3,600, for Ben was 3,400, and then for Chad was 3,200. Then we are going to debit the goodwill account. We are going to debit the goodwill account using the new ratios that we were given. So what we are going to do, we will write here goodwill written off. We will have Anne did not have, so did not get on that. So we'll have Ben 2,000 and Chad 2,000. So we'll have Ben 2,000 and Chad 2,000. Then we are going to get the share on share of land revaluation. So we were told that the land was revalued upwards in the gain. So what we do, from our additional information here, we are being told that from additional information number 9, on that 1st December, the partners agreed to revalue the land upwards. So we indicate that, for example, let me just do that here. Let me do it here. So the land was revalued to 3,200 from, so let's get the total value. What was the cost of land? Land costed 2,400. So from 2,400, so that is 2 million, because it was in terms of thousand. So the additional cost, or the value, the amount that was the land valued, it was revalued upwards by, so we have to 3,200,000, 3,200,000 minus 2,400,000 we will get the land was valued up by 800,000. So if these two were to share this using the previous normal profit, so Anne was to get 5/10 times 800,000, which is equals to, Ben was to get 3/10 times 800,000, which is equals to, then Chad was to get 2/10 times 800,000, which is equals to that. So we'll get, let me open my calculator, we'll get 0.2 times 800,000, and could get 160,000. Then Ben was to get 0.3 times 800,000. Ben was to get 240,000, and then Chad 0.2 times 800,000. Chad was to get 160,000. Sorry, and is 0.5, not 2. You know, I took 5/10 as a half. So 0.5 times 800. Yeah, take the corrections. My rubber is not. Wow. I'm just trying to find the eraser. Hold on. So okay. So this is 400. So Anne is 400. Ben is, let me write that. In terms of the new proceeds that they had to share for revaluating the land, Anne got 400,000, Chad 240,000, and then no, Ben 240, and then Chad 160,000. So in terms of in our capital account, we have share. We'll indicate that as a share of profits. Not share of profit, sorry, share of land revaluation gain. Share of land revaluation gain. We have said Anne got 400. We're just putting it in terms of thousands. Ben 240, and Chad 160. I hope you have seen how we have calculated the share of the land revaluation. So we get by how much was the land revalued, then we are able then to calculate how much each got in terms of shares using the first sharing ratios that we were given. Then of course we will talk about the goodwill on the goodwill account. So in terms of the goodwill, Anne got 2,000. So we have 2,000. That is in terms of thousands. Ben 1,200. Ben is let me just, sorry, I'm just trying to erase so that I can represent it correctly. So we have goodwill. So we have Anne got 2,000, Chad got 1,200, and then Ben got 1,200, and then Chad 800. So if we get our balancing figure, so if you add 3,200, so this is 3,600. Let me check on the calculator. So we are going to have 3,200 plus 160 plus 800. We will get 4,160. Then we have 3,400 plus 240 plus 1,200. You will get 4,840. And then you have 3,600 plus 400 plus 2,000. You will get 6,000. So you have 6,000. So the balancing is 6,000, 4840, and then 416. So the balance carried forward will be, for Anne is 6,000, for Ben is 4,840 minus 2,000. You are going to get 2,840, and for Chad is 4,160 minus 2,000. You are going to get 2,160. That is it. Now those are the adjustments. Those are the the adjustments that we start by preparing the partner's current account. Then we come to the writing of the goodwill by preparing the goodwill account, and then preparing the capital account for us to get the balance carried forward. Now let's prepare the statement of financial position now. So now we have statement of financial position as at 30th June 2024. Now we have the cost, we have accumulated depreciation, then we have the net book value. We start with current, is it? No, we start with non-current assets. Non-current assets. Now we look at our non-current assets. We see what we have in terms of our, I have to go back to the question. In terms of our non-current assets, we have land, we have building at cost, and we have equipment. So let me just have that: land, building, and equipment. Now land is at cost of 2,400, building is at 6,400, equipment we are being told at 960. But now remember, we have been told that land, on December the partners agreed to revalue the land upwards to 3,200, and we calculated the value was the land was valued at a rate of 800, at the value of 800,000. So there's an addition of 800 that we are going to add there for us to get the new value of land now at that point, as at June 2024, the new value of land is going to be 3,200,000. So in terms of registry, so we'll start by checking on land, building, and equipment. So land was costing at 2,400 at cost. Building was at cost was 6,400. Now this is in terms of thousands. Right from the start I've been putting in terms of thousands, and equipment is valued at 960. Now let's check on the accumulated depreciation. Land did not depreciate, but it appreciated. It appreciated right from 2,000 to 3.2 million. So we are going to add the extra 800 on that. But the building depreciated. But now let's get on the accumulated depreciation. We calculated in our profit, loss, and appropriation account, we calculated the depreciation of this building and equipment. We got the depreciation of building and equipment to be, building was 128 and equipment was 144 from the calculations. But also from the question, we have the accumulated depreciation that we have been given, so we add that. So we go back to the question, we have been given that accumulated depreciation on 1st July 2023, so that the depreciation that was carried forward to 1st July 2023 was, for the building was 480, so we had that 480. Then for equipment was 220. So that is the new depreciation that we got. Then we had the depreciation that was carried forward. So if we do that, we are going to get our accumulated depreciation to be, so that is 128 plus 480, we are going to get 8, 10, car 1, 5, 6. So the depreciation here is going to be 6 or 8. We put into brackets because we are going to less this. This remains add because we are going to add. Then the depreciation for equipment was 144 plus 220. So we have 4 plus 2, 6, 364. So that will be 364. So our net book value is going to be, for land it will be 32, for depreciation will be 6,400 minus 608. If you do that, we are going to get 5,792. 5,792. Then for equipment, so we are going to do 960 minus 364. We are going to get 596. 596. So if we add that, we will get, that is if we have 3,200 plus 5,792 plus 596, we are going to get 9,508. 588. This will be our total non-current assets. Then we come to current assets. Now, in terms of current assets, we will have the closing stock, that is inventory. Inventory, we were told it was 1,800. So from the question above, if you look at the question, Sorry, I have to go back to the question. If you have to look at the question, the first additional information, the value was 1,620,000 as at that 1st July, and at that 1st June inventory was 1,800. So let's go back to our financial statements. So our inventory, we will have 1,800. Then our next our next current assets will be receivables. We are going to have receivables. Now in receivables, there are adjustment information that we are going to have, because we are being told, let's go back to the question. From the question, we are being told that let me have something where I can write that. Total receivables were 1,368, but from additional information, we are being told that that is additional information, allowance for doubtful debt to be increased to 48. So now the closing balance for the doubtful debt is what we are going to less. So we less 48 on that for us to get our we less the allowance, the closing balance for the allowance, which was 48. So we will have our receivables to be 1368 minus 48. 1368 minus 48, we are going to get, that is going to be 1320, if I'll be right. That is 130820. Right. Of course, another current asset will be cash at hand or cash in hand. Now, if we talk about cash in hand, you go back to the question. Sorry. My mouse is bringing some problems, but it's resolved. You go back to the question. From the question, we have cash in hand or cash at hand to be 84. And now another, so that I can go at once, another current asset, we are being told here that assets on general rent and rents paid in advance amounted to 100,000. So rent and that becomes a current asset, 100,000. So we'll have that. So we go back to so we have cash at hand or cash in hand, and we have rent and rates paid in advance. So cash in hand, we have said we have got is 84, and rent and rate paid in advance is 100. So if we are able to add, those are our current assets. So if we are able to add our current asset, 1,800 plus 1320 plus 84 plus 100, we will get our total. We are going to get our total assets being total current assets being 3,304. So total current assets 3,804. So if we had that, for us to get total assets, that is 3,304 plus 588. We are going to get our total assets at 12,892. 12,892. So now we will go to equity and liabilities. I hope you are right. I've been focusing more on the working rather than you, but I hope you are correct. You are in touch with me. Now, let's check on the next thing will be, we have the total assets. We will go now to equity. In equity, we will go what we got from our capital account. So in our capital account, we have the balance for Anne, we have for Ben, and then we have for Chad. So we go back to our capital account that we prepared, our capital account, and in our capital account we will take on the balance carried forward. The balance carried forward for Anne was 6,000, so we will have Anne 6,000, then Ben was 4,840, 4,840. Then of course 2,000. No, sorry. For Ben was 2,840, and then for Chad was 2,160. For Chad was 2,160. So for Ben, this is 2,840. So we will get the total. There's no need to write. We will get the total being, if we take, let me calculate that, 6,000 plus 2,840 plus 2,160. We'll get the total being, total capital account being 11,000. Now, then we add current account. We check on the current account. Sorry, we go up here on the current account. That is what we started by preparing the current account. The balance carried forward for Anne was 140, Ben 20, Chad 20. So we have the current account. We have for Anne, Ben, and Chad. So Anne was 140, Ben 20, Chad 20. So if you add this makes the total, that makes the total the total current account to be 180. So if you add that, you'll get 11,180 as the total capital. Then now we check on the current liabilities. We check on current liabilities. Now in the current liabilities, we will talk about the trade payables. Trade payables. So if we go up, so that from that information, in our question, we are going to find that we are being given our trade payables at 1,624, but also part of the current liability is going to be accrued general administrative expenses, because we are being told in the additional information. So let me take all this information once so that I don't have to come back. Additional information number 3, we are being told that as at that 30th June, general administrative expenses accrued amounted to 88,000. So that is part of the current liabilities. So let me write it somewhere. Trade payables, we have 1624, and of course accrued administrative expenses was 88,000. So if we go back to our preparation of that statement of financial position, we have our current liabilities to be 1,624, and then we have accrued general administrative. Okay, let me just we have accrued general administrative expenses to be at 88. So those are our total basis. So if we add that, we are able to get our total liabilities and equity. So if I can check out my calculator, if I had so if we had 11,000 plus 180 plus 1624 plus 88, we will get our total liabilities at 12,892. It balances. That is a good thing, that our financial position is balancing. So we have our total liabilities. Our total liabilities at 12,892, which is balancing at the total asset at 12,892. So that is how we prepare our statement of financial position. Now, for the purpose of clarity, I had already prepared it, but I wanted us to move in stage by stage. We started by partner, current account, exactly what we have done. The goodwill, writing it off. Then we came to the capital and all that. Then, of course, for proper reference, we have the well-presented table, which talks about the cost, the accumulated, and the net book value. It will show you that is exactly what we have done, and our total assets are balanced at 12,892, same as the total liabilities at 12,892, and that is our statement of financial position as at 30th June 2024, and that is how you answer the question number 2. Thank you.
So if you like this video, you can always enroll with us. You'll be able to access more of these revision sessions, and also you'll be able to find well done lectures or pre-recorded videos for all the KASNEB courses as well as CHRP. And in case of anything, you can always reach us out. We have our contact details on the screen. Feel free to call, feel free to WhatsApp anytime. So thank you, and let's meet in our next session.